Hello everybody. In this video we are going to discuss about introduction to Indias. Here for introduction to Indias we should know about the firstly gap. Gap means generally accepted audit accounting principles. So this gap, if we are only in India, we are staying in India, we want to follow our Indians accounting, then we need to follow the accounting standards. These accounting standards will be 1 to 32 standards will be there at almost, and this will be issued by accounting standard board, which is issued by the accounting standard board of ICAI will be issued for this accounting standards, where if our businesses have international wide, so worldwide or global wide, then we have IFRS. Here IFRS we have two, one is India and another one is IFRS. So India and IFRS, this will be issued by international accounting standard body will be issued this type of all IFRS. Now if we are making our financial statement as per international level, then we have two options for this. So one option will be we can directly adopt the IFRS. So we can directly adopt the IFRS, whatever the IFRS thing we can follow, or we have another option. So what is that another option? We can coverage the IFRS. So coverage the IFRS. Here the cover the IFRS means Ind AS will come into picture. This Ind AS will tell that we can go with some carry outs, some carry ins. What is mean by carry out? What is mean by carry in? Carry out means there may be change in some accounting standards has given in IFRS. So this IFRS says one treatment, then we will change some portion of will be changed. This is carry out. Is this means IFRS given one, it is saying depreciation used SLM, but we are changing depreciation used WDV. This is carry out. And carry in, we are here, we are additionally guiding the which is not given in IFRS. So here if IFRS is not saying anything, but we are adding some guidance, then it will be treated as carry out. So what is there here? The gap will be there. Firstly the gap will be accounting standards or international. If you are in internationally, then IFRS. If we are filing making our financial statement internationally, we have options. We can directly adopt the IFRS or we can go with the Ind AS. So for Ind AS coverage of IFRS, we have to carry out and carry on. Carry out means we are changing some whatever the treatments was given in IFRS, we are changing some portion, and carry in means we are adding some guidance. These are the main will be there. Now the Ind AS, we have list of Ind AS will be provided. The Ind AS list will be first one disclosure of financial statements, disclosure of accounting policies, or second one will be valuation of inventory, third one will be Ind AS 3 will be cash flow statement, fourth one will be contingent events, contingent events occurring after balance sheet. These all are will be there, whatever the list provided here. This Ind AS we will discuss in entirely for our syllabus for CA final group. Now okay, we know what is Ind AS and how it will work. Now it will change. What are the limitations will be there? Accounting standards, so they are telling some accounting standards and limitations. Accounting standards will not work out on internationally, so we are going with the Ind AS or IFRS. They are telling that some misstatements why we need global accounting standards, why using this Ind AS, benefits of using this global Ind AS, convergence or adoptions. Convergence means what we are already explained. Convergence means we are adding, we are changing, carry in, carry out or carry in. Carry out means we are changing the accounting treatment as given in IFRS. Carry in means additional guidance which is not given in IFRS, we are adapting. This is okay. Now from when to we start this Ind AS, so applicability of Ind AS we should want to know. So transition from AS to Ind AS now. So from which date we will go, which date it will start, which date, with effect from which date it will come into picture. Now here the dates may be differently they will provide. These are the list of accounting standards which as on date 39 Ind AS are notified in MCA portal. The first one will be Ind AS 1, first time adoption of Ind AS, and 102 will be the share based payment, 103 will be the business combination, 104 will be the insurance conduct. This will not there in CA final syllabus. 105 non-current asset held for sale and discontinued operation. 106 exploration of evaluation minerals. These are also not there in our syllabus. And 107 financial instruments disclosures. 108 operating segment. 109 financial instruments. 110 consolidated financial statement. 111 joint arrangement. 112 disclosure of interest in other entities. 113 fair value measurement. 114 regulatory defer accounts. This is also not there in our CA final syllabus. 115 revenue from contact with customers. 116 leases, and thereafter Ind AS 1 presentation of financial statement, Ind AS 2 inventories, Ind AS 7 statement of cash flow statement, Ind AS 8 accounting policies, changes in accounting estimates, Ind AS 10 events after the reporting period, Ind AS 12 income tax, 16 will be property plant and equipment, 19 will be employee benefits, 20 will be accounting government grant and disclosure of government assets, 21 will be effect of changes in foreign exchange rate, 23 will be borrowing cost, 24 will be related party disclosures, 27 separate financial statement, 28 investment in associates and joint venture, 29 financial reporting in hyperinflationary economy. These are also not there in our CA final syllabus. 32 financial instrument, that is presentation, 33 earning per share, 34 interior financial reporting, 36 impairment of assets, 37 provision contingent liabilities contingent asset, 38 intangible asset, 40 investment property, 41 agriculture. Now you get the doubt, we are taking newly from other, then we can give the serial numbers in sequence, but why we are not given sequence numbers means, now if we see 1 and 2, next we do not have 3 4 5 6, but if we are telling that we are taking this Ind AS from IFRS, in IFRS we have IFRS 3 will be other one, IFRS 3 will be separate, IFRS 5 another, IFRS 6, so we are given the serial numbers as it is the same number, putting India AS in front of number. So if that standard is not required from us, we are not taken from the IFRS, only whatever the standards will be required for India, that the standards will be taken from IFRS. Now from how India AS have been numbers, they are provided this, so how it was there, what I explained that. Next, how Ind AS has been structured, objective, what is the structure, here we will see whatever the scope, whatever the definitions, content, whatever the disclosures, transitional prudence, these all will be there. And now we should go with the roadmap for applicability. So applicability of Ind AS will be main important because it was given in exam. For this applicability we should divide into 3 phases. Now first one will be phase 1. Phase 1 will start from 1st April 2006, from 1st April 2016. Here will come all companies that may be listed or unlisted which is having net worth greater than or equal to 500 crores as on 31st March 2014, as on 31st March 2014 or 31st March 2015 or 31st March 2016. These are the date will be required. So first phase will be, we will see all companies, it may be listed or unlisted, net worth will be greater than or equal to 500 crores. If the 500 crores net worth is there, when has on 31st 3 14 or 31st 3/15 or 31st 3/16. These dates, if you have greater than or equal to 500 crores nets, and whichever the parent or subsidiary or associate joint venture of above will need to prepare their financial statement as per Ind AS. Here we should exclude except foreign companies, and NBFC will be excluded. This is phase 1. Okay, now what is there in phase 2? Here the phase 2 come picture from 1st April 2017 will come into picture. So 1st April 2017 will be the come into picture the phase 2 phase. So 1st April 2017. Now here it will tell that all the listed entities need to follow, and whoever the unlisted companies which is having greater than or equal to 250 crores, how much? 250 crores of net worth, then they need to follow the financial statement. For this 250 crores, we can see the dates: 31st March 2014, 31st March 2015, 31st March 2016, 31st March 2017, wherever it may be. If the unlisted company having 250 crores or more, then from 1st April 2017 to they need to follow the India. Yes, here also they will include the parent, subsidiary, association and joint venture of all the above, whatever they may. They will exclude only the except the foreign companies and NBFCs. This is phase 2 phases. Where after the phase 2 we will go with the phase 3. So in phase 3 the NBFC talks. So about the NBFC they will explain. So in phase 3 what they will explain? Phase 3, if the company which is meet the criteria specified in phase 2 in any year after the 31st, if 31st 3/2017, if any company meets the criteria specified in phase 2 in any year after 31st March 2017, then it shall apply Ind AS from immediate next year. Whenever the criteria was met, then they need to follow. Here the same for NBFCs also have roadmap for NBFC 3 phases. So phase 1 will be, what is there in phase 1? Phase 1 will be start from 1st April 2018, and here they will tell that all companies which is listed or unlisted which is having net worth greater than or equal to 500 crores as on date will be 31st to March 2016, this before date, and 31st of March 2017, and before date 31st of March 2018. These dates, whenever the dates, 3 dates, 31st 3/16, 31st 3/17, 31st 3/18, whichever the date, here R will be used. If the net worth is greater than or equal to 500 crores, then that NBFC will need to follow the Ind AS, and the parent, subsidiary, association and joint venture of the above also need to follow Ind AS. This is phase 1 for NBFC, and phase 2 will start from 1st April 2019. Here the NBFC says that all listed companies, all unlisted companies having the net worth will be greater than or equal to 250 crores, and when we will see here 31st March, here additionally 31st 3/19 will be added, 31st 3/2016, 31st 3/2017, 31st 3/2018, 31st 3/2019. If the company NBFC having greater than, unlisted company having greater than or equal to 250 crores, then it need to follow from 1st April India. Yes, if company meet the criteria specified in phase 2 in any year after the 31st March, so after the 31st March 2019, then immediate next year they need to follow the India. Yes, so here we are using this net worth greater than 500 crores, greater than or equal to 500 crores, greater than or equal to 250 crores. How should we calculate this net worth will be the question. So net worth will be calculated based on the net worth we need to take the whatever the equity share capital given. So whatever the equity share capital given, for that equity share capital we need to add the security premium, we need to add, and after that we need to add the general reserves. So we need to add the general reserves, and after that we need to add or less if for the profit and loss account balance, if it is surplus or deficit, based on that we need to add or less. Next, if we have any miscellaneous expenditure which is like preliminary expenses which is not written off, so we need to deduct that expenditure, miscellaneous expenditure which is not written off, that will be deducted now. Then we will get the net worth. If this net worth is greater than or equal to 500 crores, we will see of, if it is greater than or equal to 250 crores, so as on the dates, if they are in greater than this, they need to follow the India ESM. Now if company wants without crossing this net worth, without crossing this net worth means less than 250 crores or 500 crores, they have their option. So Indian company wants to apply India AS on voluntary basis, so on voluntary basis they will allow, voluntary basis also allow, but the NBFCs are not allowed to apply India AS on voluntary basis. Only the Indian companies is allow, NBFCs will not be allowed for apply India AS on voluntary basis. So only they need to follow the phase 1 or phase 2. Next, if one entity was started India AS, so if they are started as voluntary basis or 250 crores basis or 500 crores basis, they are started, then it shall require to follow India AS forever, even though their turnover is below, then also they need to follow the India AS. At present, India AS, now India AS we are talking about companies and NBFCs, but whoever the banking company, whoever in banking company or insurance companies, they as of now India AS is not applicable for these banking companies and insurance companies. Now India AS financial statements. So what are these? What are there in India AS financial statements? So format of Division 2 to Schedule 3 to the Companies Act structure. For the format, we will include Division 2 India AS Schedule 3. We will format of balance sheet, and for statement of profit and loss account, and for statement of changes in equity, and we need to include some other, that is like statement of cash flow statement and notes to account, we will to include here itself. So as per India AS 1, we will discuss prescribed India AS financial statement, what is the format given in Division 2. So guidance note was provided Division 2, what is there in this financial statement, PPA means what, and share capital means what, non-current asset means what, that all will be provided, in here. So that's the main concept here, and in next video we will provide the whatever the question answer there in this chapter.